Good afternoon, all. My name's Demas King. Thank you for the introduction. Today's panel, Global Contest for Critical Minerals, is reshaping the landscape, and the panel is going to explore this. These resources underpin defence systems, energy transitions, industrial competitiveness, but securing them is not just a matter of extraction. And the economics, as we'll hopefully hear today, the economics is not easy at all. At the heart of the tension is the supply chain itself. Miners and processors need financial certainty to build commercially viable projects. Downstream buyers hesitate to commit to long-term offtakes. Smaller volume commodities, operators struggle to access infrastructure and scale economies and get financial close on projects. Governments seek supply security while markets prioritise efficiency, as has happened ad infinitum across trading economies. Our panel brings together leaders from mining, processing, investment banking and government to explore how strategic partnerships and commercial innovation can close these gaps. To help us answer these curly questions, Mitch Hooke, AM, has provided leadership and expertise for over 40 years across agriculture, food, grocery and mining industries. Mitch is currently Chair of Partners in Performance. Lauren is Director of Investments at the National Reconstruction Fund. Lauren has over a decade of experience in banking and markets with significant exposure to natural resources. Shaun Verner is the Managing Director and CEO of Syrah Resources. Shaun was appointed CEO and Managing Director in 2017. Before that, he was with BHP for 20 years in a variety of executive roles. And Rusty Delroy is founder and co-portfolio manager for Nero Resource Fund. Nero primarily targets small cap resources explorers with emerging projects. Russ has more than 20 years experience in resources and equity markets. Let's get straight into the panel discussion. Mitch, there's a debate about where the biggest supply chain risk sits. Is it on the supply side or on the demand side? Can you separate the two?
No, you can't separate the two, but I suggest that you start with demand. Essentially, demand for minerals and metals is going to be driven by global economic growth and the factors that make it up: industrialisation, urbanisation, the digitalisation of consumers' goods, of business processes. We've heard talk about AI, data centres and what have you. Somebody threw a bit of a wet blanket over that the other day in terms of exactly how much energy and impact that's going to have in terms of demand and on metals and the like. But all of those are going to swamp by a long way what we will see in the marginal growth in demand from the energy transition. I can't see more than single-digit figures out to sort of 2035, except for lithium, cobalt and graphite, because they're new commodities, new minerals essentially. Copper, probably 6-7%, with a 30-odd% electrification sort of penetration. I don't think electrification, decarbonisation, that objective is going to turn around anytime soon. Those bridges are already blown up to turning around, but it's got to be a measured and will be a measured transition. And there's a massive materiality check going on right now. And it's largely on account of the failure is not the right word, but the lags in technology developments in energy density, in generation, transmission and storage. They're just not when the bull's raw. In terms of industrial processes, I mean, you would have seen Chris Human's thing when he was talking about Freddo frogs. You know, you've got to have gas to make Freddo frogs. Your chocolates, you can't use renewable power. And I'm not going to tell you who told him that one. And then you've got the transmission. And there's all sorts of community objections. if you're going to produce renewable energy, you've got to have 400, 500 times the land mass for the counterfactual unit of power, so you've got to bring the electrons a long way. If you don't have something like the 1,000 kVA lines, there's 2 of them in China, and they're aluminium, high voltage. If you're going to use 550 kVA coming out of the Trove Valley, your electrons are going to go. So my point is that demand has had, and 30 years in public policy, I've got to tell you, I know a policy regression when I see one. And so the wheels are back spinning in terms of where the whole net zero thing and the momentum thing goes. And so there's a reality check in the demand side. At the moment, the supply side is in surplus, which means that your commodity prices, as I was saying before, they're all going to be largely running at the long-range equilibrium of marginal costs. If you're into the 4th quartile, you're basically mining for your share traders, your share values. It's where the market's clear, the supply-demand balance. That's where the price will be. And that's why copper's running at $4, $4.20. That's marginal costs.
Yeah.
It's not the incentive prices of $5, $6, $7.
Yeah. Thanks, Mitch. Very interesting. Russ, I'm sure you've got a slightly different perspective.
I generally have alternative views.
Yeah.
Fair to say that. Look, I think if you start with demand, big picture, 2 key dynamics, they're long-term. Ongoing urbanisation in Southeast Asia. I think GavCal, as a research house, cover this better than anyone globally. There are hundreds of millions, 1 billion plus, still to go. So there's big numbers of urbanisation still to occur. It's incredibly commodity intensive. And the other big picture driver, with a 10-year view, is AI and humanoid robotics. So fundamentally, if we lower the cost of goods and services, by definition, we'll consume more of them. So that will have a knock-on effect into raw materials, unquestionably. So I think there's very little debate around robust demand, in my view. We can all talk in the short term, and there's all sorts of oscillation and variation, but long term, I think those factors are well established. And then if you go to supply, that's where we have real problems. So, Western supply, in particular, is a drama. Why is it a drama? Because we've moved from a unipolar dynamic, and we're now in a multipolar dynamic. No, it's not coming, it's here. We're in it right now. China is a superpower, right alongside the US. That is, in my mind, undebatable. And as such, suddenly there's awareness around supply problems in the West. And so for 30 years, we've effectively deindustrialised processing of raw materials, and we now are slowly waking up to what that means. And it's most pertinent in rare earths and critical raw materials, but it's way broader than that. There's 60% of aluminium, 60% of iron, 50% of zinc. They're all processed in China. So they dominate that landscape. It's deeply uncomfortable for the West. We're only just working that out, and we've got a lot of work to do to get anywhere near fixing it.
Thanks, Russ. Shaun, from a supply side perspective, what are you seeing?
So in the graphite space, we are absolutely dominated by China's supply. Anode material going into lithium-ion batteries is 95% produced by China. So the pricing, as Mitch said, is below the cost of production, and competition is absolutely rampant. Anode material production capacity in China is probably 3 or 4 times what's required now, and there is still capacity being built. So the question on the supply side in the Western world is, what do customers actually want? Do they want supply that is not wholly reliant on China? And if they do, are they prepared to pay for it? Because there has to be some sort of price differentiation to incentivise projects to be built. And you need contracts to underpin funding, whether that be debt funding, whether it be the confidence of your equity investors. People need to see those contracts in place. So, the supply side is absolutely a China story in graphite. Goes for a lot of the critical minerals at the moment, and there's some big questions that Western buyers have to answer.
Thanks, Shaun. Lauren, your organisation, the National Reconstruction Fund, is part of the government's agenda to try and close that gap. Are you seeing the potential for that to close with what the National Reconstruction Fund is looking to achieve? Where do you see the orders of magnitude in terms of the changes that need to be made to close that gap, if it's closable? And it's okay to say it's not closable.
Yeah, I suppose it depends specifically what gap you're referring to here. Are we thinking about specific critical minerals where governments have strategic requirements, whether that be for defence or other strategic areas? Or are you kind of applying a broad brush to, you know, Australia has 30 plus critical minerals, the US has 50. If you're looking for to close that gap across all of those markets, I don't think that is achievable. Yeah. In terms of what the National Reconstruction Fund does, we have been established just about 2 years ago now to invest in manufacturing and value adding in Australia. We're a $15 billion fund, and we can invest debt or equity, and resources is one of the priority sectors that we can focus on. So we have quite a unique perspective, I guess, in terms of being an instrument of public policy, but also our mandate requires us to achieve a commercial return. So, if you look at project fundamentals, a big challenge of what we see here in Australia is actually cost competitiveness. Some of that, and we're seeing kind of developments around that in real time, is around long-term offtake agreements. But if you look at an ASX announcement of a long-term offtake agreement, it's probably 5 years, and that's not really going to underpin the debt and equity investment that's required for these projects. To build the industry in Australia, we need something much more longer term, and that's where I think governments, and not just Australia, I think crucially we have to cooperate. We are not China, we cannot build the end-to-end value chain here, so we need to do that with partners, and we need to find a way to collaborate with allied nations.
So just expanding on that a little, it's clear we can't do the end-to-end supply chain here. There is a big segment of that supply chain that we are nowhere near competitive in. When a mining, or let's just call it, when a mining project comes forward across your desk, I'll start with Ras. What are you looking at when you're looking at that mining project and its bankability, investability?
Yeah. From an investability point of view, it's really fundamentally where do you sit in the cost curve.
Yeah.
Commodity markets by definition are volatile, so they're going to oscillate. If you're an investor, you want to ideally find somewhere where you're comfortable with that variability. So even in poor markets where you're testing cost curves, trading within cost curves, you've still got a viable operation. So that's the key. It's really a cost function, and I think to even offtakes and length of offtakes and really what I think you said was within your mandate, ultimately it's like, yeah, but what's the return? So the return in a mining project is ultimately a function of margin, and margin is a function of cost. So it all comes back to cost, right? These commodities by definition are homogeneous. You can't separate yourself out at the moment by a brand. You get paid, a unit of copper is a unit of copper. And as long as that's the case, then the only way to compete is on cost, and we're fundamentally uncompetitive across the board on cost. And 2 years ago we could have sat here and talked about a pretty robust nickel industry in Australia. It is now completely eviscerated, and in my mind never coming back. And that is because it is fundamentally uncompetitive. And that is coming for us beyond nickel. So we have really serious self-reflection required to work out how we stay cost competitive in the global landscape.
And are you talking about the entire value chain, or are you more focused on the processing and refining end of the spectrum?
Yeah, they're all interrelated. Ultimately, somebody's got to sell a good at a price, and it's got to be competitive. And if you look at like Chinese automotives, for instance, they were in irrelevance 5 years ago. They're now the world's largest auto exporter. all of the cost of the final good is partially a function of the cost of the inputs. So the cost of the inputs have to remain low, and China is wiping the floor with us. And how are they doing it? Scale, without question, throughout the value chain, but even in mining and mineral processing. They're doing it with scale. They're doing it with low-cost, reliable power. And specifically within nickel, as an example or a case study, they're doing it in a dynamic where the regulatory risk is low. It's pre-permitted. All the tape, however you want to define it, is dealt with. So there's no risk. You can go and turn soil tomorrow, and if you start tomorrow, they'll build an anode factory within 9 months for you.
Yeah.
So the problem is actually getting worse, not better. The direction of travel here is also a problem, because 30 years ago you could have turned around and said, yeah, but they don't know what they're doing and they're going to copy us and maybe they'll get there. Well, that's already happened. So
Absolutely.
now they own all the tech in mineral processing. We don't do it. We told ourselves we're clean and green and the West doesn't do all that filthy stuff anymore. Well, if you go to war, that might be a problem. So, I think there's growing awareness around this, but we're not having conversations around the fundamental problem. And the fundamental problem is cost. And cost is a function of regulatory and power. They're the two key drivers.
Lauren, does that, do you have anything you wanted to add to that or argue against what Shaun put forward?
Yeah, look, I think that's absolutely fair. And for the majority of projects, that cost piece is absolutely fundamental when they're selling into broader markets where they may have a long-term offtake contract and it may have a price floor, but ultimately they're still going to be exposed to movements in commodity prices. What I would say, though, is that if the Western world actually places strategic value on non-China supply and sustainable supply as well, then some of the mechanisms around pricing and for example the transaction we saw with MP Materials, that makes the cost piece somewhat less relevant. So I guess the other aspect that we would think about is the technical risk about some of these critical minerals projects.
Yeah.
Copper, obviously well established, you're not worried about that, but when you're developing a new rare earths mine, in a country where, yes, we do lack expertise and experience in doing that over a long period of time, that's another key aspect when you're assessing a project.
Yeah. Before I come to you, Mitch, Shaun, I'd like a miner's perspective on what Lauren and Russ just talked about.
Yeah, sure. Look, cost absolutely is key, and from our perspective, we've got the largest resource in the natural graphite industry, and that's the reason it got developed. It is the best resource, and at the scale that it can operate, it should be in the first quartile in the cost curve. The issue is that demand hasn't caught up in the ex-China world, and that's because customers want a co-located source of supply. They want it to be accredited to Western standards. They want it to be uncontracted if they can get it, so available when they want it, not necessarily on a long-term contract, and they want it at a China price. And these things are just fundamentally inconsistent, and it's not until customers actually take a diversification decision, and it's things like what we've seen with Chinese export controls and the policy that really demonstrates the risk, that leads customers to say, okay, I'm going to have to take a decision to price differently for at least part of my book and make sure I have an alternative source of supply. But you still need to be at the right position on the cost curve to be able to sell into it. And the other fundamental is that we will never be able to compete on capital cost. We might get there on OPEX, but building a facility in the US, as we've done, or in Australia, we just can't compete with Chinese capital costs.
Yeah. I want to go to you, Mitch, but I also wanted to flag the next question in my mind, which is the surge in government-to-government strategic partnerships.
Before you go there, can I just pick up?
Yeah.
You introduced, when you were introducing Russ, you said, you'll have a contrary view. Well, I don't see anything contrary in what I've heard. I mean, let's drill it down. When we're talking supply, let's get beyond the sort of generic. In terms of the primary materials, the primary commodities, we're pretty damn good at that. And we're actually fairly competitive. Costs, I suggest we start thinking about that in the context of how we use costs. So it's a productivity equation. Our productivity is heading south and has been heading south for a decade and a half, about 3.5% per year in multi-factor productivity, so we're about 30% on a CAGR basis. We're about 30% worse off than we were a decade and a half ago. Okay, so it's how you use your costs, because costs always rise to revenues. Okay, and they're structured when they're up there. Okay, 75% of our costs are fixed. Yes, there's drift on the way up, but mostly it's structural. So they're up there, so don't think you're going to go and cut them unless you're going to take out value generation capacity as you go. If you don't know what your value drivers are and you start whacking away at costs, you could end up cutting off your nose to spite your face. So that's an equation. Then you get into the midstream, and these guys are absolutely spot on. We're 10 to 15 years away if we started today building the capacity for that midstream processing and refining. The head of Alcoa said, well, Trump wants to bring in tariffs so that the 4 million tonne of aluminium, they call it aluminum, but aluminium that's coming down from Canada, that'll take 7 state-of-the-art smelters. They're $5 billion each, that's $35 billion. They're going to need about 500 to 1,000 gigawatt hours of power for each one. Work out that out for a market cap organisation of what, $3.5 billion? They're going to need 35 billion. Not going to happen. And if he had permits today, take him 8 to 10 years to do it. You get the drift? So what Russ said, and that is, well, we haven't woken up to this for a while. When I said in an audience about 8 years ago, this is a national security imperative, there's not critical minerals, they all kind of looked at me as if I was smoking something. And so when you get in, sorry, Russ, that's a little bit. So when you start talking about national security, it's exactly what Lauren was saying, and that is, well, governments can't be divorced from sharing in the cost of taking on a national security imperative.
Yeah.
Okay? Yeah. China has cleverly built a dominance in the supply chains of those industrial endeavours that are of strategic importance to the West.
Yeah.
We talked about energy, defence, manufacturing, all those sorts of things.
Yeah.
Very, very clever in terms of them wanting to be part of a dominance. In a keynote address I was giving, the guy, Chen Haran, was head of the thing. This was back in the days when I was relevant, and Syrah Eddington was chairing it with Hugh Morgan, and the guy was sitting with me, and we just finished, and he turned to me and he said, that was great, Mitch, perfect English, great, really, when I say perfect, you wouldn't have thought anything like that, but he said, it's our turn. I said, what? He said, yep. I said, what, you ran the show for the first 1,800 years of the Common Era, and this is now where you want to go? So that laid out the platform for this broken down farm boy, and I didn't really kind of believe it, but that's where they've gone. So the cost thing is imperative, all those sorts of things. Where do I see it coming? We've heard today. Where are you going to go for partnerships? How are you going to get alliances? The risk is that when you go ally shoring and reshoring, you're going to piss off the other side. And we're seeing the retaliatory action. And where's the market? China, India, Brazil, Africa, the Middle East. Who's aligning themselves to be counterproductive with us?
Yeah.
The saving, not a saving grace, but one thing to look at is protection damages primarily the protecting economy. Eventually, it does become lead weight in your saddlebags. Have a look at China's economy.
Yep.
Highly indebted, poor growth, local government investment vehicles. What's happening? The urbanisation, industrialisation, spot on, but they've overbuilt capacity, they've overstated their welcome, they've overstated their place, and they've got so much overcapacity they're now dumping products and predatory dumping into Western markets. Right? There is a day of reckoning. The reason why the world is round, because if you throw enough of that fecal matter up there, it eventually comes around to get you.
Thank you, Mitch, which leads us straight to the Western government's response, which is strategic partnership and building
preferential trading blocks.
Preferential trading blocks, secure, they might say secure supply chains. is that a good thing or a bad thing? Shaun?
I think it's a necessary evil if we're going to have any ex-China capacity built. In our case, we secured over 4 years 2 US government loans in the support of building downstream capacity in the US and supporting the upstream mining operation in Mozambique. But the reality is it was extraordinarily hard and long to get those in place. And even once they're in place, the markets are not mature yet. Pricing is opaque, demand shifts, and most of the institutions are not built to deal with that type of volatility.
Yeah.
So this does need to happen if we're going to get alternative sources of supply. But it goes back to the question of, is there a customer there to buy it, refine it, and ultimately, have an end market that is demanding this material and demanding that it doesn't come from China.
Yeah.
And the government support is pretty critical on the supply side, but that question has to be answered at the same time. There's no point in adding supply if that customer's not there and the government's not working with the demand.
There is a bit of that already with governments intervening. I mean, the foreign entities of concern stipulation in the Inflation Reduction Act that Biden introduced says, there's a gradation of percentages of Chinese investment and source product to the point where 2025, if you're over 25%, you're persona non grata. And it's in all of the free trade agreements plus Japan, because they don't have a free trade agreement with the US. So that stuff is already happening. The question is, how effective is that alliance going to be?
Yeah, thanks, Mitch.
I'd like to go to that.
I'll catch you later. No, 7 minutes 39, you can run up there. We've seen that surge in government-to-government strategic partnerships. The question is, government intervention actually means a cost on the taxpayer
and consumers,
and a distortion in the market. Is that something that that needs to be considered deeply in terms of the implications for the Australian taxpayer or the strategic partners taxpayer and the longevity of it? Remembering that the Japan Linus deal was done in 2010 and is still absolutely in force. But perhaps design is the big issue here, and design is certainly the big issue in the strategic reserve that the government's currently working on. Lauren, I'm not sure whether you've got any insight into that, but do you have any general comments on the proposition of the size of the burden on taxpayers, whether it's here or in our strategic partners?
Yeah, absolutely. I think, evidently that there is a cost to taxpayers into investing this money into this sector as opposed to another. But I think, the overall view is that in terms of a strategic outcome, that cost is outweighed by the benefits. And if you're particularly talking about the things that we need for defence, I think that the investment is worth it. I think you're absolutely right in terms of the structure and design. I think the strategic stockpile really has the potential to be quite valuable for Australia in catalysing some of these projects. But I think it's going to be a combination of tools. So whether that's commercial investment by the likes of the NRF, where you're aiming to achieve a commercial return for taxpayers, or something more akin to the stockpile, where that might be a much longer term investment. I think there needs to be a balance. But you and I spoke before the panel around the length of time since some of the first MOUs and cooperation agreements have been signed. It's been many years, and even the US government, the success of Obama administration, Trump version 1, Biden, Trump again, that they've all allocated funds to a certain extent to critical minerals, but it has not moved the dial. So if we're serious about this, then something needs to change quickly, and we do seem to be getting that momentum.
Shaun, any views?
No, I mean, I think ultimately, unless the governments have a decision to make on a national security level, the US has started to make decisions about which commodities it wants to see production of or processing of domestically. But unless those decisions are made and money's invested quickly, we will be fully reliant on Chinese supply in many of these critical minerals for some time to come.
Yeah. We've got 4 minutes left.
Before you go
and
on to that one, you didn't throw to me.
We've got 4 minutes
ask you a question.
left, Mitch. You've got
10 seconds.
10 seconds.
What's worse than having to pay too much money for something that you absolutely need? Not being able to pay for it at all.
Or not having access to it at all.
That's my
Yeah,
point.
yeah.
Okay, so think of this stuff through the prism of, yes, we prefer to have open market economics. We'd have market access.
Yep.
The US closed its Bureau of Mineral Resources in just after the Uruguay round. Okay, Australia gave China market status in 2016. So, we'll have this global interdependency. Will it come back? Will it override? Yes, it will. It's not going anywhere. But the question will be, what is the market failure and the reason for government to intervene? And don't leave the calf on the cow's tit forever. It's got to be there as a remedial measure and then get back out.
Yep. Nice sum up, Mitch. I'd like to throw to the panel for one last question. What's the most important shift, policy, market or mindset, that could unlock the alignment across critical minerals supply chain? And I'll come to you last, Mitch, because of your last response. Sure.
Yep. So,
Sorry, Russ, not Shaun.
no worries, no worries. So look, fundamentally it comes to cost. I will keep coming back there. We are uncompetitive. It is a function of regulatory environment and power. If you accept that economic output is energy converted, then the cost of your energy is deeply influential on how much GDP per capita you can generate. So we must address those issues. These are fundamental issues. And right now we continue to make them worse.
Yep.
So I think any conversation around other matters is important in the short term, but longer term, we have to solve these problems, because everything we've been talking about here today is a form of a subsidisation in one shape or another, right? So people don't sit well with subsidies for very long. That's my experience anyway. So what are the mechanisms that can work today, I think is also important. And at the moment, it's all very piecemeal. There's little bits and pieces, there's different ideas in different administrations. I think a strategic stockpile makes a lot of sense. China plays that game. They use their strategic stockpiles, that they extend market troughs, they then acquire assets, they do all sorts of nefarious things. So that makes sense. And secondarily, what can you do today? Well, use an exchange, formalise an exchange. Formalise that to sell a good in a country, the inputs that go into it must have come from an exchange. That exchange defines certain levels of characteristics in the production, and then we can all meet that level. So it's an even playing field. Until that happens, the rest of it's just
Semantics.
Window dressing.
it's window dressing, and it'll go around, and a different group will come in, and it'll be more bureaucracy and more wasted money that doesn't. As an example, in lithium, 5 years ago, that China was 65% of the processed lithium market. They're now 70. So we're getting worse, not better.
Yeah, thanks, Russ. Lauren.
40 seconds between three of us. Yeah, I think the shift is happening in real time. We need to get money to the most strategic projects. But I also think, to Rusty's point, that needs to be backed up by regulatory change to make sure that the projects can actually get built cost effectively.
Thanks, Lauren. Shaun.
I agree 100% on cost with Rusty, but I would say that if customers don't cure their addiction to lowest possible cost supply from China, then there will be no inducement of projects anywhere else, because ultimately they're the ones who make the purchase decisions.
Yeah, really good point. Mitch?
Added to all of that, I agree, throw in technologies, throw in advanced technologies. Don't try and promote technologies to taking a Maserati to businesses who've only ever driven an FB Holden. We're not that flash at actually understanding the circumstances of the markets we're serving. When it comes to government, yes, there's going to be a short-term intervention, but there ought to be a longer-term examination of what are the fundamentals that facilitate or are conducive to investment. Russ handled them, Lauren's handled them, Shaun's handled them. They're all out there. We could run through them as a list. We don't have any time.
We don't have time.
And the last point I'd make is let's get a reality check. Let's make damn sure that our expectations and our objectives are aligned and reconciled with our capacities. You heard it here this morning when one of the speakers said you've got to reconcile what you're doing and where you're going in terms of decarbonisation with your capacities. At the moment, the ideology and the objectives and the aspirations are so far out in front of capacity that we're actually artificially inflating. Last point, I said it in the last panel. China is less than $100 end user per megawatt hour. America is around 150. Australia is either 200 or north. Europe is 250. Germany and the UK are 350. You can't compete when you've got lack of scale, lack of technologies, lack of sophisticated manufacturing, and you've got that lead weight in your saddlebags. Good luck.
Great point. Thank you all. Can you all help me in thanking the panellists?